Paying taxes used to feel like taking a test where the teacher let you change your answers after the bell rang. If you forgot a deduction or needed to erase a typo, you could file a correction later without breaking a sweat. The Central Board of Direct Taxes has rolled out new ITR forms for assessment year 2026-27, driven by the Finance Bill 2026, and they are completely rewriting the rules of engagement. We are moving from a forgiving analog process to a high-speed automated assembly line. The system now demands absolute precision the first time you submit. Treating this digital architecture with the old fix-it-later mindset triggers automatic, inescapable financial penalties. Let's start with what looks like a big win for small taxpayers. If you own 2 house properties, you can now report income from both of them using the simplest tax forms available, ITR1 and ITR4. This is a genuine relief. Previously, adding a second property forced everyday salaried employees to navigate complex schedules full of irrelevant categories like capital gains and foreign assets. But the convenience of using a smaller form comes with a trade-off. To use these simpler forms, you must feed the system highly itemized data for every single detail of both properties. As this diagram shows, you must itemize municipal taxes, home loan interest, and TDS for each house. The moment you hit submit, algorithms cross-reference these numbers against your annual information statement. If they don't match, the system knows instantly. These simplified forms act as a highly efficient dragnet. They are designed to extract perfectly organized, pristine data straight into the government's automated verification algorithms. Now, let's say you catch a typo in that data, and you decide to file a revised return. If you make that correction late, specifically between December 31st, 2026 and March 31st, 2027, you have to pay for it. Under Section 234I, revising late costs 1,000 rupees if your income is under 5 lakh rupees and jumps to 5,000 rupees if over. Why? You're charged for the server load as the system reruns millions of lines of code to recalculate your profile. But paying a fee to fix your own mistake is the best-case scenario. The worst case is when the AI catches a discrepancy before you do and fires off a reassessment notice. When that notice generates, it comes with a Document Identification Number, or DIN. This assigns a precise, unalterable digital timestamp to your offense, leaving absolutely zero room to argue about when the notice was sent. If you file an updated return in response to that specific notice, a new rule, Section 140B3A, kicks in. You will be forced to pay an additional 10% penalty on top of the original tax and interest you already owe. The tax infrastructure now financially weaponizes your delays. Waiting around to see if the department actually sends a notice is officially the most expensive mistake you can make. Surviving this setup requires an immediate shift in how you handle your paperwork. You need to gather every municipal tax receipt and TDS certificate by May, so you can guarantee absolute accuracy before you even start typing. File early, ideally by July. And if you do spot a minor typo, fix it strictly before the December 31st deadline, so you don't walk into that $5,000 trap. The tax department has built an active digital ecosystem, engineered for automated enforcement, operating completely independent of human intervention. We are rapidly heading toward a future where artificial intelligence might just track our bank accounts and file our taxes for us. But until that day arrives, you have to get it right the first time, or you are going to pay for the privilege of a second chance.